Imagine I'll give you $50 for sure, or you can flip a fair coin for 100. Now that's a stupid example. Imagine you can keep all of your net worth or lose half of it in a divorce. Hey guys, Chris here for Hustle and Bustle. Last time we talked about loss aversion, and today we're going to talk about risk aversion. If you're new to my channel, my mission with this channel is to provide you with more value, with information about finances, motivation, creating wealth without all the hype. Also, I want to show you that everyone can do it. You don't need to be rich, have rich parents, inherit their wealth. Life is what you make out of it at the end of the day. So if you want to help me grow this channel, please hit the like button for the YouTube algorithms and consider subscribing. Your time is valuable, so we can always watch the video on faster speed, 1.25 or 1.5. Now before we continue with the video, I noticed that the camera is not looking great, so let me fix that. It was just dark there, I guess. Alright, let's dive into the video. In economics and finance, risk aversion is a tendency of people to prefer outcomes with low uncertainty to those outcomes with high uncertainty, even if the average outcome of the latter is equal to or higher in monetary value than the more certain outcome. How do I remember all that? If I don't, my wife just beats me. Now, risk aversion explains the inclination to agree to a situation with a more predictable but possibly lower payoff rather than another situation with a highly unpredictable but possibly higher payoff. Hence, my divorce example. So a risk-averse investor might choose to put their money into a bank account with a low but guaranteed interest rate rather than into a stock that may have high expected return, but also involves a chance of losing value. Now, let me vent about the example of risk aversion that I found all over the web when I was doing my research for this video. Should you take the guaranteed $50 or should you flip for 100? Now, if you play poker, you might notice those two examples actually have the same EV, or how we say, the same expected value. So in a vacuum, that doesn't really matter. In a vacuum means with no other information given to the situation. It is a poker term. It is usually used to describe when I meet you for the first time in the poker table when we play our first hand. This hand is in a vacuum. We have no prior history. I haven't seen you, haven't played with you, I have no other information about you. So, in a vacuum, it really doesn't matter what we're going to choose. The example wants to show us that the risk-averse person will choose the guaranteed $50, but I don't agree with this example because it's only theoretical, and in practice, I might choose to flip for 100 because honestly, $100 is not that much. I can care less about $100. But if you offer me 50 billion or to flip for 100 billion, I'll take the 50 billion. Obviously, because that will set me up for life. So I think the example should be something along those lines. Would you like to get X for sure, guaranteed, or you want to flip a coin for double, 2 times X? This way, our financial situation does not play a role in our decision. So, Wikipedia and all other financial websites, please fix your example. If you're still watching, please help me grow this channel and smash the like button for the YouTube algorithms and consider subscribing. I don't know why I did that. Now, why I started doing some segments on theory is because I think it's important, and on later videos we will be talking about real estate deals that we bought and that we consider buying, and those theories will come in handy. It's the same with my real estate videos that I started with the basics so I can get everyone on the same page. You can check them out on a playlist. You can check them out on this playlist. I'll list it right here and down in the description below. So soon we're going to talk about more real estate and more advanced strategies, but now since you have the groundwork laid over, since you have the basics, now it's going to be easier for you to understand when we talk about HELOC, RELOC, and other financial strategies about real estate. So all in all, risk-averse person will prefer the safer deal with lower return to the riskier deal with a higher return. And obviously, the way overwhelming majority of cases, a higher return potential means higher risk. Not always, but 99+% of the time. Now, if you have two deals and they're gonna yield the same amount of money or the same amount of profit, and one of them is more riskier than the other, obviously, logically, you should choose the less risky one. Alright guys, thank you very much for watching. That was a short video, the same like the previous one. I'm gonna spew more content in the next weeks. Thank you very much for smashing the like button and for watching the video till the end. I'll see you next time guys, keep hustling.